EP Wealth Advisors Informed Investors series on how to build your investment portfolio. My name is Breene Murphy. I'm the Director of Client Experience here at EP Wealth Advisors. I'm joined by Adam Phillips. He's our Director of Portfolio Strategy. He's a chartered financial analyst. He's a certified financial planner. He's been quoted in the Wall Street Journal. You may have seen him on CNBC and the TD Ameritrade Network. He's also been included in Forbes' list for the 2019 Best in State Next Gen Advisors. And today we're going to be talking a little bit about how to allocate your portfolio, how to pick a stock, a bond, a mutual fund, and the role they play, so that you can have a better understanding of how to build your portfolio.
Thank you for joining us. One of the things that we've gotten is an understanding of risk, right? And I don't think people understand that there's multiple types of investment risk, right? And there's kind of 3 or 4 that you would like to highlight. Would you be willing to elaborate on what those are?
We often try to minimize the amount we have in cash, and I think you hit it right on its head. I mean, we're in such a low yield environment right now that unless you really think that inflation is going to be completely absent and is not a threat at all over the foreseeable future, then you're not being compensated to hold cash right now, and that's by design. Really, that's what the Federal Reserve has been doing for years now. They are keeping rates low to try to inject some kind of activity into the economy. They're incentivizing that risk taking. Okay, but it doesn't just mean that you want to take excessive risk. Doesn't mean it's necessarily appropriate for someone to have an all stock portfolio. But there's some balance there. And if you look at fixed income, if you look at bonds these days, the yields aren't great, right? They're going to be better than cash, but they're not great. And I think what we've found is that it's something we often refer to as TINA. There is no alternative. If someone needs yield,
Is that why you married Tina?
That's why I married my wife. Yeah, Tina. And but if you have a retiree who's relying on the portfolio for income, yields aren't that great in the bond market. So where are they going to go? They're going to go to other riskier asset classes like stocks, where the dividend yield is actually higher than the yield you can get on a lot of bonds. But you want to do that a little bit at the margin. You want to control those 2 risks, and so that's why we see a lot of diversified portfolios right now, because you have stock to allow for give you a better odds of having that real rate of return that you need, meaning adjusted for inflation. So you get a nice opportunity for growth, but you can offset some of that downside risk by having some in bonds. And I think that's the way that we just need to manage right now. It's all about having a diversified portfolio for these changing, the changing circumstances. With the Fed, as you mentioned, it's about offsetting that policy risk with inflation risk, and there's rising interest rate risk, and so there's a lot of different things at play. And I think that's just kind of where we find ourselves now, and really the longest expansion in history and a more than 10-year bull market. And I think it's about just really understanding what you own and why you own it, and having a diversified portfolio. So I think that's really the name of the game right now.
Okay, so that's all really good, all those different types of risks. And I get a conceptual level, but I'm trying to understand it more viscerally, right? So could you give an example of a type of downturn that would affect this type of risk? Let's say inflation, or let's say, monetary policy would have did to bonds, or let's say, market risk, and just then get an understanding of how the other risks have performed in that environment as well.
Sure. So let's choose one. Okay.
Great Recession. So that portfolio saw a lot of market risk, right, at that time. But not monetary policy risk.
Not monetary policy risk. And so the way that, in general, the way that monetary policy is going to respond to an economic and really a market downturn, certainly of that magnitude, is monetary policy is going to have to come to the rescue to inject this stimulus, right? To make easier policy. That means cutting interest rates. It means injecting liquidity, billions of dollars into the financial system to try to get the economy to gain its footing.
Right.
Okay.
Which is really something that's been bipartisan. We saw it with both Obama and Trump.
Absolutely. So what that means is that in that environment, stocks they fell off a cliff in 2008. You had your bonds to partially offset that.
Mm-hmm.
Now, as the economy started to kind of gain its traction, and granted, it took several years, but the Fed eventually started to try to normalize policy, meaning they had cut rates so much they were down near zero.
Right.
So what they tried to do is start just slowly but surely start inching rates higher,
Mm-hmm.
and that subjected portfolios to, bond portfolios specifically, to monetary policy risk.
Mm-hmm.
That's where, and we spoke earlier about the risk of having bonds that are too long-term in nature, and the risk there with rising interest rates. That's where you wanted to kind of be careful about not reaching too much for yield,
Mm-hmm.
and having that interest
Right.
rate risk, right? And so that's how we were managing around the risk at that time.
Thank you so much for watching Adam and me. Please subscribe to our blog. In it, we'll send you new blogs, obviously, but also webinars, videos, as well as Adam's white paper, The Informed Investor Market Outlook. So sign up today, and thank you so much again for watching.